Hi, good evening. Hope you are good. So this is another episode on cost and management accounting. And today we'll be talking about cost behavior, cost estimation, and then also cost prediction. Right. We'll be running at a very top speed in this session because um there are a lot of stuff in here that might not be relevant to our exams, even though they are in here where we can learn it for our personal sake. But during class session, we are more interested in high and low method. So I think when we get on other methods, we are going to jump up and then first discuss more on high and low methods and then close for the day. So my name is Nehemiah and today I'll be taking you through cost behavior, cost estimation, and cost prediction. So basically, when we talk about cost behavior, right, we are talking about how cost relates or behaves according to output or activity levels. Right. So that's basically what we are coming to do. We are coming to use some methods to estimate cost, how they behave, how they relate to output level or activity levels, right? So our coverage will be classification of cost by behavior, which we have fixed variable, fixed cost, variable cost, mixed cost, and then step cost. Then methods of cost estimation, we are going to talk more about the historical methods, which we are going to focus highly on the high-low method. Right? Scatter plots are there, account analysis are also there, regression analysis methods are also there. The non-historical methods, we have engineering and conference methods. They are all there, but our main focus for this session will be more on the high-low methods. All right. So at the end of this lecture, students should be able to understand and appreciate how cost responds to activity level. That is the event that leads to cost. And then the segregation, then segregate total cost into fixed and variable component, and predict cost using linear quantitative what techniques. So basically, our main aim in using high and low method is to what? Separate total cost into fixed and then variable cost, right? So high and low methods will help us know our fixed and variable cost in a total cost. So total cost will normally be given, and then our main aim is to what? Divide them into two. All right, so cost accounting is all about providing cost information to management for planning, control, and decision making in an organization. To effectively do that, managers must know the cost in their organizations. So they must know their cost structure. Cost structure is relative proportion of each type of cost, which is fixed and variable, to the total cost present in a firm. So analyzing cost structure of a firm means understanding the cost behavior pattern of the various costs. Cost behavior is the way or how cost responds to changes in activity level, as I've said earlier on. The behavior of cost to changes in activity level. All right, that is the behavior of cost to activity level. So activity level is also referred to as activity base or cost driver. That is the event or activity that results in the cost. Yesterday, in the previous session, I spoke about this. So it is expressed in various forms. Typical ones being capacity, volume, output. Example, machine hours, units produced, units sold, labor hours, and etc. All right, this is how introduction does. By knowing all the cost behavior, cost structure can be analyzed properly to forecast the level of cost at any particular level of activity. This is cost prediction, right? Which is essential for planning, control, and decision making. The behavior of cost changes in activity levels forms one basis of cost classification. In this way, cost can be classified into what? We have direct fixed cost, variable cost, and then semi-fixed cost. So For variable cost here, this changes in total in direct proportion to activity level. So variable cost changes in total in response to activity level, but does not changes in per unit, right? If activity level increase by 10%, the total variable cost is expected to increase by 10%, right? Then fixed cost, this remains constant regardless in activity level or cost driver. This includes rent, rate. So basically, what we are saying is that fixed costs remain constant in a relevant range, right? But when it's out of the relevant range, we have the step up cost, right? Okay. So semi-variable cost or mixed cost. This cost changes in total, but not in direct proportion to changes in activity levels. If activity levels changes by 10%, total cost may change by 18%. It's also called mixed cost. It is the cost that has both fixed and variable cost components. All right. Example, electricity, repairs, telephone, maintenance. All right. They vary with activity level, but not in direct proportions. So the fixed portion of a mixed cost represent the basic minimum charge for just having a service ready and available, right? So for example, as far as you have a meter in your shop, you are going to pay a monthly ECG bill, whether you use or you don't use. So in every month, everyone who buys light or have meter pay for street light and the other ones, right? So that will become your what? Your minimum distance that at least as far as you have a meter, you are supposed to what? Pay for. All right. So the variable portion represents a change made for actual consumption of service. So for the normal one, whether you use light or you don't use light, you pay. But once you are also using light, you have to what? Buy light. So that will become the variable part. So the more you use the light, the more you buy more electricity power. That's it. So as expected, the variable element varies in proportion to the amount of the service that is consumed. Assumption on cost behavior. So the classification of cost into variable and fixed cost is valid within a narrow band of activity known as the relevant range. So within a particular period of time, that's what it means. The relevant range of activity within which actual operations are likely to occur without changing cost. So it is the range of activity level that fixed cost is assumed to remain constant or assumption about cost behavior is valid. So outside the relevant range, we are not able to estimate what cost behavior. So if you pay a rent for let's say a 1 year, right? The relevant range is within the 1 year. After 1 year, who knows? Rent fee might change, right? Or you might what? Let me use that one like that. What it means is that fixed cost can be fixed at a given period. Beyond that, it could change. Example, rent and rates could change. Yes. All right. Point to note about cost behavior. Again, even though the classification is based on changes in total cost to changes in activity level, the reverse is the case when it comes to per unit. Variable costs vary in total as volume changes, but it's constant per unit, right? You will see a table just after this one to talk more about fixed costs are fixed in total, but per unit as volume changes, right? As volume increases, fixed cost per unit decreases. Some variable cost changes both in total and per unit. So variable cost is volume related. That is, it changes with volume. Fixed cost is time related. It changes what with time. There is also a minimum assumption of linearity. That is, if total variable and total fixed costs are plotted on a graph in relation to activity level, they appear as unbroken straight lines, right? So basically, they will go they will never meet. So even though other cost drivers may affect cost, whatever. All right. So this is the figure for the variable cost, right? We can see that activity level what is changing here. 250, 500, 750, and the likes. 1,000 is also here. Total cost also what? Total variable cost also what? Increases from 7,500 to 150, 15,000, sorry, 222,500 to 30,000, right? So meaning that what the total variable cost what keeps changing. But look at the variable cost per unit. It is what 30 throughout. So this talks about this that variable costs vary in total, but it's constant per unit, right? So that's what we are having here. Now this is fixed cost. Fixed cost is what? Activity level is increasing here. Fixed cost is what? Constant in total. Doesn't change in total, but what changes in what per unit. So that's what we are having here, that fixed costs are fixed in total, but per unit, as volume changes, volume increases, fixed cost per unit or decreases. That's what we are having here. So you can see it is decreasing, decreasing, and decreasing. That's it here. Then semi-variable cost, as you can see, irrespective of the activity level, right? Total semi-variable cost will change, and total cost, the total cost per unit variable cost will also change. So it changed there, both of them changed there, both of them changed there, and both of them changed there. That's what we are seeing here. So on a graph, this will be our what? Our total variable cost line moving, and our fixed total variable cost per unit is what constant. That's what we are seeing here. And then for fixed cost to fixed in total, and then what decreases in what per unit. So as we know about this, most of us, I'm sure almost everyone, because we have treated this several times in our economics time. So variable total costs here. So this is the total cost line. This is the fixed cost line. So the difference between the total cost and then the fixed cost becomes the variable cost. And that's what we are seeing here. So the step up cost, I said that whenever uh, within the relevant range, right, we have a fixed cost. Anytime there is anything outside the relevant field, we get what? A step up cost. So step up cost, these are costs which remain constant for a relevant range or for a range of activities that are fixed within the relevant range. Then when activity increases further, the cost has to be increased by a significant amount, right? Example is supervision. For a range of activities, for example, one supervisor will be insufficient, but there comes, one supervisor will be sufficient, but there comes a point when an additional supervisor has to be appointed because the scale of activities has what increased, so the cost has also what increased. So this is more of the step up cost. This when activity level increases, the step up cost also has what increases. So cost estimation to predictions. Managers on daily basis plan, control, and then what take decisions on products, activities, resources consumption, and cost resulting therefore from. To effectively do this, managers must establish the relationship between activities and cost. Costs do not just happen. They are caused by activities. Cost estimation is the process of establishing a relationship between cost and cost drivers. As in what causes cost. Yesterday, I said that in case you bring a girl to your room as a man, then you make some kind of expenses. It is because of that lady. That's why you are buying that food, fried rice, because an normal person is actually eating banku, right? But because the ladies, yeah, you buy Don Simo, fried rice, and the likes. So that's the cost driver. So the estimation process answers the following question. What causes the cost? How do costs relate to the cost drivers? How do costs respond to changes in activities? The foregoing means to estimate the cost, the manager must know how the organizational costs behave to changes to activities. Cost behavior therefore underline estimation. By knowing how organizational costs behave to its activities, managers would be able to estimate, predict, or forecast what their cost would be at any activity level, at least within the relevant range. So all our predictions that we'll be doing today will be within the relevant range, not outside it. So the classification of cost based on behavior basically puts cost into two, namely variable and then fixed. Semi-variable or mixed cost is combination of the two. For cost estimation in an organization, all costs should be segregated and classified into either variable or fixed. So this simply involves segregation of all costs into variable and fixed, right? There are two broad approaches or methods used to segregate total cost into variable and then fixed in order to predict the cost. The methods have variations. They are estimation using historical, which is past data, then estimation using non-historical, right? So the historical ones is like using previous data. So estimation using historical data. With this method, cost estimation is based on historical, like what has already been there already, right? So here, the relationship between cost and activity level are observed in the past. Is studied and segregated into variable and fixed cost. The variation under these methods are accounting classification methods, high and low method. And I told you the high and low method is our main objective for this particular session. Then visual fit method, which is scatter graph, and then least square method, which involves a whole lot of calculations, mass, like. So account classification method. So under this method, it's also called what? Account analysis. It's also called account analysis. This involves a careful examination of what organization's ledger accounts. The cost analyst, based on his knowledge and experience of the organization's activities and costs, classifies each cost item into fixed and variable and then semi. So what the manager is or the account analyst is going to do is that he or she will look into all the costs available and then he is going to what separate them into fixed and fixed and variable and then semi-fixed, right? So direct material as variable, depreciation as fixed, and then utility as well semi-variable. Once cost is classified, analysts may then examine job cards, labor time cards, and other source documents to predict cost. This method has obvious drawback of being time consuming and lacks what objectivity, as it leaves room for analyst judgment, because the analyst might not be able to what judge the cost correctly. But so now we are on the high and low method. So the high and low method will just look into looking at the highest activity level and then also the lowest activity level. Then what the high and low method will do is that it will use the highest activity level to find the variable to locate the cost associated to it, and then the lowest activity level to also what locate the cost associated to it. So let's do this here. Let's see. So let's say activity level here and then cost. Let's say 2,000. The cost is like 17,000. Half thousand. The cost is like 15,000. Then we have let's say 1,200. Then we have let's say 1,300. Right. Let's take it something like this. Right, let's take something like this. So what high and low method is going to do is that high and low is going to select the highest activity level. The highest activity level here is what, 2,000, and then its cost. Then the lowest activity level here is what, 1,000, and then also its cost. Right. So what high and low method is coming to do is that it will use this to what? To determine the variable cost per unit. Right. So this is what it is going to do. Remember, our main aim is to what? Divide this total cost, this total cost here into fixed and then variable, since we don't know them. That's our main aim in what? High and low method. So what we are going to do is, for us to get the variable cost per unit, it is change in cost over change in activity level. So change in cost is going to be the highest cost, 17,500, minus 15,000, all over change in activity level, which is 2,000 highest minus, right? So we are going to get 2,500 all over 1,000. So we are going to get 2.5 Ghana cedi per unit, right? Right. So after doing this, what we are going to do is remember our total cost function, which is TC is equal to fixed cost plus variable cost. Total fixed cost plus total variable cost, right? So now what we are going to do is we just have to just take one of the activity levels, right? And then its cost. So we can assume and then use either the highest activity level or the lowest activity level. So let's use, let's say, the highest activity level, right? Let's say we are using the highest activity level. Remember, total variable cost is equal to the per unit, the variable cost per unit, right? VC per unit times the output or activity level, right? So that's what we are coming to do now. So total variable, total cost, right? As we know already. So we want to what? Find the fixed cost now because we have variable cost per unit. So what we are going to do is that we make the fixed cost standalone and then we bring the total variable cost. So it is going to be FC, fixed cost is going to be TC minus TVC. Remember, we are now going to use the highest activity level. Right, the highest activity level, FC, we don't know. TC was what, 17,500. And then the activity level is going to be, the total variable cost is going to be 2.5 times 2,000 because that's the highest activity level. That's what we are using, the highest activity level, 2,000, right? So with this, FC, you can quickly punch it on your calculator. FC is going to be FC is going to be 12,500 Ghana cedi, right? And since we know this already, our variable cost is also what? CVC is also 2.5 times, it is going to give us 5,000, right? So basically, that's the main aim of whatever we are doing today. We are just going to separate the total cost given to us into what? Fixed and then variable cost. So looking at it here, this is our fixed cost, this is our variable cost, total variable cost. We are done. So simple, right? So I've just done some illustration here. So now let's go. Assume the maintenance costs for Andor and Co have been observed as follows within the relevant range of 5,000 to 8,000 direct labor hours. But they've given it to us. They've already given us the highest and then the lowest activity level here. Yeah. So now look at it here. So what we are going to do now is we are going to select the highest activity level and the lowest activity level. Then we locate their prices respectively. Then we are going to use it to calculate our high and low method. So it seems so you can try your hands on this according to what we've done. Just try your hands on it and then separate this cost into what? This total cost or maintenance cost incurred into fixed and then variable, right? So it seems obvious that there is some variable cost elements as maintenance increases, activity level increases, but not in direct proportion. To separate the variable cost element from fixed cost, relate the change in direct labor hours, then between the high and low methods, so on forever. So that's the same thing they are doing here. Take the highest activity level, the lowest, then we allocate their cost. Remember, we are not talking about the highest cost and lowest cost too. We are talking about the highest activity level and lowest activity levels and their cost attributed to them respectively. So that's what we are doing here. So the cost, the difference between them is what? 1,000 minus 700. They're getting this. Then that's the same thing that I just did. So I don't need to even talk to it, otherwise the video will be long. Right. So now we use the same formula to what? Differentiate them. Total variable FC is what? Total variable, total cost minus variable cost, and it's as it here. So now the cost has been separated. This becomes our what? Our fixed cost, and then our variable cost will be what? This 800. So both the fixed and variable costs are now isolated. The cost of maintenance within the relevant range analyzed can be expressed as being 200 plus 0.1 or 10 pesos per direct labor hour. So that's what we are also having here. So we can express it that in case we want to, then our total maintenance cost is going to be plus into bracket 2.5 x, where x would be what? The activity level, right? So that's basically it. That's the same thing here. So this can be used to predict total cost of an activity level within a relevant range. So that's the same thing we've done, same process, right? So now we are now on visual fit or scatter graph method. So here, the available set of data is plotted on a graph. That is, the cost at the various level of activity level is plotted. So if, let's say, this is how it will look like, right? So because it's a graph thing, you draw a graph, activity level, and then cost will be here, right? So various activity level, if let's say 1,000, 2,000, 3,000, and the likes, that's the cost. Let's say this is the cost activity level. Let's say 70, 100, 150, going and the likes, right? So they are going to plot all the distance. So everyone said the first one is 70 and then 1,000. The second one is also 180, 100, and then let's say 3,000, right? Then let's say the last one is for this and then this. To plot everything, then now what they are going to do is they draw a line of what best fit, a line that will what fits everything in the relevant range, right? And they use it to what calculate the distance. So that's what it is saying here. So the analyst then visually fits a line to this data by laying a ruler on the plotted point. So more or less like drawing a line that will fit everything. So if let's say the thing was something like this, and then the next one too was something here, then they are going to use a line like this, right? That's what it means here. So the line is positioned so that a roughly equal number of plotted points coordinates lies above and below the line, right? They make sure if you see, for example, if this was scattered, they put it in the middle so that almost everything is equal below or above. But because I use this I added another example here, then I brought it in this. All right. So the graph is known as scatter graph, and the line fixed to be plotted point is known as the regression line. So at the y-axis, vertical axis, cost. So that's the cost where the regression line intersects the instance. So what it means is that here is the cost. So where it starts here, for example, if in case I'm using this, then here, where it's starting becomes the first cost, right? And then anything within here becomes the what? The variable cost, right? That's it here. Variable cost and base cost, then total cost, right? Something like that. I'm ignoring this. I'm just using this for my example. So because of this, accuracy is what therefore enhanced. The drawback is the lack of objectivity, as two analysts can draw two regression lines using the same data. So people can differently draw some lines. So there is an example here where you see, because you have four different listing down and four different things. So you draw a line that is what perfectly in it. So where the starting point of the distance begins is what the regression line, and becomes the total cost. Then here becomes the fixed cost. Then the what is in the middle here becomes the variable cost. So the least square method, this is more sophisticated. Yeah, we know. Sophisticated, sorry, approach to the scatter graph. Rather than fitting a regression line through the scatter graph data by simple visual inspection, the least square method fits the line by statistical analysis. The method is based on computations that find their foundations in the equation for a straight line. So they use the normal straight line equation, y is equal to a plus bx, where the y is the dependent variable, which the total cost here. A becomes the fixed cost. Then B becomes the degree of variability, like the variable cost per unit. X becomes the activity level, like what we just did. Same thing. So now this becomes a least square method equation. Summation of x times y. So they'll give you x coordinate, y coordinate. So x times y plus x times y plus x times y is equal to a times the summation of all the x's plus b times the summation of all the x's squared. So x squared plus the next x squared plus the next x squared. That's what it means here. But at our level, we weren't really introduced to it, so I wouldn't really talk much about it. So that's the same thing here. All right. And this is the same thing as I've explained. So basically, the number of what? The number of the distance times the x when you want to look for b, right? This is the formula. The number, if let's say they are 10 times the summation of x times y plus, so x times y plus x times y plus x times y, 1 sir. So this is just the formula that you can follow with your eyes. So points to note about using historical data. Regardless of the method used, the resulting cost estimate would be only as good as the data upon which it is based. The following affects the data and consequently the accuracy of the estimation. So there is what? A missing data. So misplaced source document or failure to record a transaction can result in what? Missing data. We are talking about the what? The accounting formula no, or the accounting method. So we can also have outliners when we are using the scatter graph. These are observations that fall outside the others. This could be an error or the data could be correct, but due to unusual circumstances. Then inflation can also what harm our data. Then the effect of experience curve. So labor and other variable cost declines by a certain percentage as output doubles. This effect is not given recognition in cost estimation, as the assumption is that variable cost increases as activity level also what increases. So there is a single factor assumption. Other factors may affect variability of a total cost other than the cost driver. For example, apart from total mileage traveled that affect total maintenance, age of vehicle being maintained, and man hours machine required to perform maintenance, numbers of fleet of vehicles, etc., would affect maintenance costs. But only these factors would be assumed rates, the rest being what? Held constant. So there is the what cost estimation using non-historical cost method. So with this, the process of cost estimation is to study the process that results in cost incurred. There are two variations, engineering method and conference method. So cost estimation and inflation. So now we are going to talk about high and low method, that is what involving inflation. The behavior of cost to changes in activity level is referred to as cost behavior. Cost behavior classifies organizational cost into years and within the relevant range remain constant and the likes, regardless of the changes in activity level. So the foregoing means that total cost relating to one activity level volume within a relevant is influenced by total variable cost. Cost associated with the activity level to say difference in total cost. Difference total cost of two activity levels is accounted for by difference in variable cost at least within a relevant range illustrated. So the higher total cost of higher output is equal to fixed cost plus the variable cost, right? So the total cost of the lower will be subtracted from the higher one. You'll be left with the difference. Then fixed cost in the lower and then the higher will remain the same. So they will be cancelled out. Now it will left with the variable cost of the difference in output. However, because of inflation, total cost may increase not because of volume, but for inflation. Businesses have established a relationship between activity level and cost to estimate cost. In order to estimate correctly and reliably, the effect of the inflation present in the past data should be removed. There are two approaches to do that. So the technique is used when so deflation past cost to be to a base year. So what you are going to do is that first you deflate the cost to the base year, right? Then with high and low method, only two past data is utilized. The idea behind this approach is that to be able to compare the two extremes correctly, right? So this is done by deflating the past. So coming. So let's use this example. Let's use this same example, right? And then we have and then we have that this index in the era. So let's say for this first one, the index is what? Let me see, 120. And let's say the second one is right. So with this one, before we find the change in the cost, right? Before we find the change in the activity level and cost here, we'll first what deflate this cost, right? So what it means here is that it is going to be the cost times 100 over the index. Because we are using high and low method, which is the first two distance, right? The first two, which is the highest and then the lowest activity level, right? We are going to use the cost here to be 17,500 times 100 over 120, where we are going to get approximately 1,458. So we are bringing it down because of inflation. Then the other one will also be 115,000 times 100 all over 140. So we are going to get 15 times we are going to get around 10,714. Remember, it is still change in cost over change in activity level. So let's say that they are trying to what? Estimate the price in what? 20, okay, the years are not part. Let's say they are trying to estimate the price in the next this thing is going to be inflation rate is going to be around, let's say, 160%. The next index is going to 160, right? Where they want to use the estimation. It's like Lempan's a 160. So what we are going to do is we find a change in activity level and then the distance, which is going to be change in cost over change. So 1, 4, 5, 8, 3, minus 10714. Remember, change in activity level remain the same. 2000 minus 1000. It is going to be it is going to be 3 point, let's see, 87. So this is going to be our what? Per unit variable cost, right? So now what we are going to do now is we factor in this and then get our fixed and then variable cost. Let's take one of the activity levels, right? Let's say the first one. Let's still use that and the first activity level. So where we use our old formula now. So FC is going to be uh, TC minus CBC, right? So now we use our normal distance. So our fixed cost, we don't know. Our total cost after the deflation at the highest distance became 14583, right? Now minus our total variable cost is going to be into bracket 3.87 times reaching the highest activity level, say 2000. So with this, FC is going to be now it is going to be 6, 8, 4, 3. That will be our fixed cost. And our variable cost is going to be our variable cost is going to be 3.87 times the 2000, which we have in the brackets, get 7740, right? Which would cause our total cost to be the same 14583. That is going to be our total cost. Right? So now Now, since we've been able to what identify our fixed and then what our variable cost is here, right? Let's assume that they want to what produce, let's say, they want to produce, let's say, 3,000 units. So they want to produce, let's say, 3,000 units, right? Now, let's what predict our new activity level, like our new variable cost. This is for the 2,000. This variable cost is for the 2,000. So our new variable cost for this fixed cost will remain the same, right? So our new variable cost for the 3,000 this is going to be, so variable cost for 3,000 units is going to be 3.87 times 3,000. Let's see what we get. 11610. Right. So now we add this to our first cost. 6,843. Then plus 6,843. We get 18,453. So this would have been our raw total cost when we want to produce when we want to produce 3,000. But remember that it is estimated that at that time, inflation rates will be, or inflation will be around 160, right? So what we are going to do is this. Now to get our current listing, there's going to be this total cost, right? Times 160 over 100. Remember the other one was what? The 100 over the index. Now it is the index over the listing when it is getting to the end, right? So this is going to give us this is going to give us 2,952,4, right? So our total cost for 3,000 units after the adjustment of the inflation, right? After adjusting, this is what we are going to incur. So that's basically it for the high and low method. Now let's go back to the slide and then see. So the same thing here. And then, okay, so you see, the first one is what? The total cost times the inflation, 100 over the inflation index. Then estimate or determine the total cost for the future period. Then now inflate the estimated total cost using the formula total cost are price index over what? 100. So that is what is happening here. So now with this one, we are going to select the words. We are going to select the highest activity level here, which is what? 45,000. And then it's what? Associated this thing. Then the lowest is also here. And then it's associated what? Total cost. Then we take the what? The indexes into consideration. So what we are going to do is we are going to deflate this first. And then later on, the one towards what cost will be expected in 2005 if output is expected to be what 42,500 and then a price index of 180, right? So that's what we are coming to do now. So they took the highest, the lowest. Then now they deflated the price, the total, the cost. The total cost being this was deflated. This one was also what deflated, right? And then this means the total cost for the two extreme would have been those values in. So Now we have, this will be what's the difference. The high and then the low, we subtract to get the difference. And then now the deflated cost, this is it. Then this is the same thing. So when we divide, we are going to get what, 1 as the variable cost per unit. So variable cost is this, then total cost is this, then we get our fixed cost. So fixed cost is this. So now for us to get the cost in the 2025, we now what, multiply the variable cost by the output that we want to produce, and we get our total variable cost of this. We add it to our fixed cost. Then we get our total cost. Then now we inflate it by the inflation this thing. So now we get our what's this. So that is it. I hope this is not confusing, right? This is very, very, very simple. In case you are having, so okay, sorry, this brings us to the end of this session. In case you have any question, you can drop it in the comment section and then I'll what, tackle it. All right, so kindly like this video and also subscribe to the channel if you find this helpful. Thank you very much for your time. Have a nice day. Bye.